Corporate bond is essentially a loan made by an investor to a company. Corporations often need to raise capital for various purposes, such as expanding operations, funding new projects, or refinancing existing debts. Corporate bonds is a common way to raise capital. When you buy a corporate bond, you are lending money to that corporation. In return for this loan, the company promises to pay you regular interest payments over a specified period. This interest payment is known as the coupon rate. The principal amount of the loan, known as the face value or the par value, is repaid to the investor on a specific date, which is called as the maturity date. Corporate bonds can have different maturity dates, ranging from a few months to several decades. The longer the maturity period, generally, the higher the interest rates offered, as it compensates investors for the increased time their money is tied up and the potential for greater market fluctuations. Bonds are considered debt instruments, meaning they represent a contractual obligation for the issuer to repay the borrowed money. This differentiates them from stocks, which represents ownership in a company. Because bondholders are creditors, they have a higher claim on the company's assets than stockholders in the event of bankruptcy. This means bondholders are typically paid back before shareholders if a company goes out of business. The creditworthiness of an issuing corporation plays a significant role in determining the interest rate it has to pay. Companies with strong financial health and good track record are considered less risky and can issue bonds at lower interest rates. Conversely, companies with a higher risk of default must offer higher interest rates to attract investors. Credit rating agencies like CRISIL, ICRA, CARE, etc. assesses the financial health of companies and assign credit ratings to their bonds. These ratings provide investors with an indication of the bond's risk level. Corporate bonds are traded in the bond market and their prices can fluctuate based on changes in interest rates, the company's financial performance, and overall market sentiment. If market interest rates rise after a bond is issued, the value of existing bonds with lower coupon rates may fall, and vice versa. Despite these fluctuations, corporate bonds can be an attractive investment for individuals and institutions seeking a steady income stream and a relatively lower risk alternative to stocks. They offer diversification to an investment portfolio and can be a good option for those with a more conservative investment strategy.